Hey traders, Todd Gordon here with TradingAnalysis.com. This is for CNBC's Trading Nation. Traders, let's go to work on hedging some downside risk here in the NASDAQ. We're on the 30-year anniversary of the 1987 crash, and we're seeing a bit of volatility with the market at a quite precarious position. So as we look at the QQQ, this is the tracking stock of the NASDAQ ETF. Now, if we take a look at the technical position of the NASDAQ and we connect the trend lines, you're going to see that they are converging. They're coming together, and that generally suggests a loss of upside momentum. It's kind of the same thing if you throw a ball in the air. At some point, its upward ascent is going to start to decrease. The rate of change will decrease to the point where it stops moving up, and then it begins to reverse and gravity pulls it back down. Well, we're starting to see that with the shape of the QQQ on the daily, and we can also quantify that with the relative strength index. This is the RSI, and basically what this is doing is tracing out a series of lower highs, which indicates that the loss of momentum in the underlying Qs is occurring, even though we are making new highs. So let's go ahead and see if we can hedge a possible downside move to the lower end of this trend line, right around the $145 region. Before we do that, I just want to make note of a couple key large cap tech stocks that are not making new highs relative to the summer of 2017, where the NASDAQ clearly has. Number one, Amazon, coming up with earnings on the 26th, clearly off the summer of 2017 highs, nowhere near that high. Another one, Apple, well off the summer 2017 highs. Also on my list is Google, slightly through the 2017 highs, certainly not with any kind of conviction. And the last one, believe it or not, is Facebook, also kind of struggling with those summer 2017 highs. So again, just going back to the Qs to illustrate the point that NASDAQ is well through those highs. So those large cap tech are underperforming. So I think it is time to hedge our long portfolio with some downside put spreads. So let's go out to the November 3 options. These guys, only 16 days out at the time I'm recording this video. We don't need that much time if this sell-off is gonna happen. It should happen relatively soon. So let's go ahead and buy the $145 put. This is a full $3 below the current market, so it's an out-of-the-money put. We're going to pair that up with the sale of the 43 put. We're going to have to pay only about 22 cents or $22 per option spread. That's the max risk that we take in the trade. So we're risking $23 to potentially make 177. So a really, really good reward to risk ratio. This is only going to kick into gear if the NASDAQ really starts to take a dive here in the next 2 weeks. So let's go ahead and put the trade to work. And that trade is now working. Now, you want a position size such that the entire 22 cents or wherever you get filled at the time you're seeing this video is you're willing to accept that entire loss if the trade is not going to work. I'm willing to just put that 22 cents out there. If that downside hedge expires worthless, that's fine. It is going to serve as a hedge to our underlying long portfolio. So no need to put a stop loss on this particular trade. For CNBC's Trading Nation, I'm Todd Gordon. Good luck on that portfolio hedge in the NASDAQ. Be sure to follow us at Trading Nation on Twitter for updates of this position, as well as all the other trades our traders are watching. And we'll see you guys in the next video update.